Now, there's something else I'm seeing that's an opportunity in this market that I'm absolutely loving what I see right now, and that is housing stocks continue to roll. So, if you don't know, I'm obviously looking for hedges for 2024. And I'm going to likely execute on some of these hedges probably within the next, I'd say, 3 or 4 months, right? Because I need some hedges for 2024 just in case the market tanks, anything like that, right? And so a few of the places I've been looking is kind of the home builders. And so I'm secretly rooting for these stocks to keep going up, keep going up, keep going up for this next few months until I do my hedges, right? Because I want these stocks to be as maxed out as possible kind of on the upside. And obviously, if we know if the economy was to get hit in a substantial way, if interest rates were to drop, both those would actually hurt the housing stocks pretty significantly, because if interest rates drop a bunch, then a lot more people that have existing homes are going to consider selling their homes to move, right? Which is going to basically change the inventory kind of trajectory we've been on, which is not going to be good for housing, because these players have been able to hold up pretty well in this market because inventory has been so low. So people are like, crap, I got to go buy a new house since existing homes are so few and far between right now, right? And also, obviously, if there's a major recession coming, like that's going to devastate these housing stocks. We know what happened in the great financial crisis to these companies, right? So I just look at that as a pretty attractive hedge for next year. So I'm just secretly rooting for these stocks. Go up, baby, go up, go up, okay? Now, Whirlpool's a stock I've been looking at as a potential buy, right? The stock's been hit heavily, and I've been considering this one. Stock's done nothing over the past 5 years, right? It's up 11%. Of course, you collect dividends over that time, so you're up more than 11%, but it's not very good, okay? But when it comes to Whirlpool, I looked at the numbers, and they just weren't impressive, right? Revenue's still going down for the company. Gross margin down for the company, right? Selling general administrative was actually up for the company. Operating profit looks like it was up nicely year over year, but really it would have been down substantially, because the previous year they had an impairment of goodwill and other intangibles here, and also they had a gain. They had basically a loss in disposable business here that hurt their numbers last year as well. So nonetheless, folks, when I look at Whirlpool, I can just tell you, like, the business is in actually a worse place this year than it was last year, which is hard to believe. Earnings, once again, it looks like it has nice growth year over year, but that's because of these things here, okay? Net earnings came in at $85 million, right? As far as EPS, came in at $1.56. They paid out $1.75 dividends, so basically they're paying out more in dividends than what they have come through the door in EPS. So nonetheless, Whirlpool, I'm still keeping my eye on it. I might be intrigued at some point, but it's just not it right now. Chipotle. So Chipotle down huge after hours. Down $188 a share after hours. Down 9%. I came so close to buying put options on Chipotle that expire on Friday. I was literally about to put in the order, and I was like, that's just a stupid gamble, Jeremy. Like, what are you thinking? Like, this gambling Jeremy talking. I always have this bad guy on my shoulder who's like, hey, puts on Chipotle. And I'm like, dude, no, okay. He was right, but at the end of the day, I'm still glad I didn't do it, because that would have just been a straight gambling move. But, so what happened with Chipotle? Is it a complete disaster? Well, why don't we dive into the numbers and see, is this a complete disaster? Woo! Revenue increased 13.6%. Comp store sales increased 7.4%. Anybody that knows anything about comp store sales or comp restaurant sales, that's ridiculous, okay? That's amazingly ridiculous. In-restaurant sales increased 14.8%, while digital sales represented 38% of food and beverage. Operating margin 17.2%, that's an increase from 15.3%. Restaurant level operating margin 27.5%, an increase of 230 basis points. Diluted EPS of $12.32, a 33% increase versus the previous year. What? Opened 47 new restaurants with 40 locations, including a Chipotle? I don't have to look into that. Okay, the numbers are flipping amazing. Okay, there's no way you can look at these numbers and be like, this is bad. No, these numbers are amazing. They're about as good as it gets for a company like Chipotle, to be honest. Okay, but there's a huge problem. Why don't you see me out there buying Chipotle stock this year, okay? I'll tell you exactly why. There's a huge problem here with Chipotle, and it has nothing to do with their revenue or comp store sales or profitability or any of that. This is the issue with Chipotle, the valuation of Chipotle. At the end of the day, we know, Chipotle's built out, obviously, an immense amount of restaurants over this past 15 years or so, right? So in terms of new locations, I don't want to say they're maxing out, but, because they can always put more Chipotles out there, but I'm just saying like the big growth days on a percentage basis of Chipotle are behind it rather than in front of it, right? Just natural numbers. But the company has this ridiculous valuation on it. It trades at this year numbers based upon what they're supposed to earn this year, 46 PE. Based upon next year, almost a 39. I mean, those numbers are incredibly high. And you're talking about, these are the sort of valuations that you would expect from like a high-tech growth stock, like, I don't know, a Tesla. Remember, Chipotle's got much higher valuation metrics than Meta. Chipotle trades at about double what Meta does, roughly, in terms of forward PE for 2024. That's pretty extreme, right? And so the reason I'm not buying a stock like Chipotle, and I'll show you the stock I'm buying that I think is a much, much better play risk-reward, is I just look at this company and say, great company, great numbers, but the stock trades so rich that it's basically stolen so many gains from the future. And so you're setting yourself up for, if the company comes in with any troubling numbers over the next couple of years, let's say margins go down, let's say revenue goes down for whatever reason, whatever, you're setting yourself up for potential big downside in the stock. And when I say big downside, I'm talking 40 to 60% downside, okay? On the flip side, how hard is it to get a company like Chipotle to double over the next few years? It's very difficult because of the valuation it's already trading at. It's very difficult when you already got that sort of forward P on you to then, talk about the next level of growth. So for a stock like Chipotle, the risk reward at this point in time is just not super attractive. A few years ago, it was a different situation. Back when they were dealing with all the health problems that they had in some of their restaurants back in kind of like, gosh, what year was that? That was like 2015, 2016. That was a really attractive time for Chipotle. I mean, the stock was trading at $200, $300, $400 a share at that time. If you want to step in then, that was a very interesting time to be stepping in Chipotle. At 2,000 plus, or anywhere near those numbers, it's just the risk reward is not good. So where I find a much better risk reward, in my opinion, in this market right now is Cake. Cake is expected to have stronger EPS growth on average over the next 2 years than Chipotle, right? But the difference is I'm paying super undervalued prices with Cake, right? We're talking about 13 times this year's projected numbers and 11 times next year's projected numbers with Cake, right? With still strong, location growth, especially because of North Italia and many of the other concepts they have. So when I look at something like Cake, I say the risk reward is so much more attractive. The chances I double my money on Cake over the next few years is much higher than Chipotle. And the chances I lose 40 to 60% of my money over the next few years is much lower than something like a Chipotle at the end of the day. So that's why at the end of the day, when I look at, kind of the restaurant category, I'm going to go with something like a Cake over a CMG. And if I wasn't to go with that, I would go with, Texas Roadhouse, kind of next up there, right?